Hello. Hey everyone. I'm Kunz Mainali. Should we start with intros? So I'm Kunz Mainali. I work at Bitwave. We're a SaaS platform for tax, accounting, bookkeeping, and reporting, used by a lot of companies in the crypto space, ranging from staking to Web2 companies to large crypto enterprises. I have a background in trading. I'm really excited to talk about the bridge between traditional financial products and NFTs. I'll hand it off to Vivek.
Hi everyone, my name is Vivek Raman. I'm currently at an institutional crypto platform called Biduda. Our goal is to bring institutional adoption into the crypto space. And the path here started in TradFi. I was in TradFi for 10 years in New York, trading high yield and distressed bonds, which are a very, very good use case to actually bring on chain. Then went into the real estate world, another great use case to bring on chain. Then I came fully into the Web3 Ethereum ecosystem, and then now sort of my mission is to unite the two and bring institutional and traditional finance all on chain.
Yeah, hey guys, and then I'm Jason Brannigan. I'm general partner of Kronos Ventures, which is the ventures arm of Kronos Research, which is one of the biggest market makers in crypto. I've been in crypto personally since 2014, and I worked in traditional finance for 5 years at a $5 billion pension fund. So again, I think we've all kind of seen the use cases like firsthand and sort of witnessed the inefficiencies. So excited to talk about them.
Thanks for the introduction. So let's dive in. The first topic I want to talk about is why NFTs versus fungible tokens and what financial products actually look like. So if you think about traditional financial products and what NFTs versus fungible tokens are at its core, fungible tokens, you can have multiple representations of an asset, whereas for assets that you may have that have very unique properties, NFTs are more well suited. The example I like to give is obviously real estate being the most common, and Vivek will dive into that. But the idea is that there are many properties that make one property different from another, whether that's the zip code you're in, the build style, whatever products you use to make the home, if it's wood. That all makes these products different. So when we tie this into traditional finance and the products that they issue, if you have things like homes or things that are very unique in nature, or contracts, within contracts you have various terms that make one contract different from another. Whether that's maturity dates, durations, interest rates, those are much better represented in an NFT. When you begin to securitize these assets, tranche them together and cut them up for investors to invest in, there, you can then introduce fungible tokens as a representation of these assets, while the NFT is the representation of the collateral that you have. Vivek, you want to dive into the real estate use case and talk a little bit about that?
Sure thing. So stepping back to one overarching thesis is we had in the last 2 years a roaring bull market in crypto and then a pretty bad bear market where it really exposed a lot of crypto's inability. It hasn't evolved to where it's become ubiquitous yet. In fact, crypto is actually built against having the institutional incumbency, and I don't think it's really that zero sum of a game. Like we have this zero sum mentality in the last bull market that we will replace the financial system and replace the real estate system and replace everything traditional. And what our use case is isn't just bringing a bunch of random numbers on chain and then having people trade them. Like that doesn't do justice to what crypto's potential is. So how do we take a step back now that we've basically been given a huge reset button and we have a lot of the regulatory eye on us and we have all jurisdictions looking to see how they can either use us or ban us? I mean, it really is a moment of reckoning for crypto. And I think the way for us to step up is to say, let's reset. Let's say that, okay, most of the existing tokens out there are just kind of useless, but the underlying technology, the infrastructure that blockchain's created is ripe to bring in real world assets on chain. And how do we do that? That's not through fungible tokens, as Kunz was saying. It's not through having ERC20s that are just representations of literally nothing. Why don't we take something like real estate? Let's start with that because that's one of the most inefficient and fragmented markets in the US. And globally too, where every single, as Kunz was saying, every single property is different, every single title is represented differently. It's governed on a county by county basis. It's very, very inefficient. Why don't we take a digital representation, standardize it across all different counties, all different states, even nationwide, and that way and let's put it on a public blockchain, which is basically a public internet, so you can't lose title. Anyone can look it up and see and track ownership. And once we digitize this physical market, then we can bring in this whole innovation of tokens again. Okay, how do we securitize pools of properties? How do we group them by geography or by region or by like apartments versus houses versus skyscrapers, and then allow more people to invest in different tranches. That's the real innovation of crypto, I think. I think we've done a good job with the foundational blockchain layer. We have Ethereum as a public blockchain that can be a digital property records, a digital property record, which is a phenomenal technology. It's non-tamperable. It's we all know the benefits there. But now our next step is working with, not against, working with governments and counties and municipalities to bring real estate title on chain, and then show the benefits of why this is better. It saves transaction costs. It's easier to lend and borrow against. It's easier to verify ownership and title history. And it makes the existing system better. And I think if we have that attitude for the next bull market, it'll be more sustainable. Everyone will use it, and it'll just be a better bull market. So that's sort of the vision for bringing real estate on chain.
Thanks, Vivek. One question I had for you was, I'd heard of some use cases where there are traditional REITs, so real estate investment trusts, that use the homes, that the use case would be that the homes within the portfolios are NFTs, and then actual ownership in the REIT is represented via like a fungible token. Do you have any thoughts or comments on that?
Yeah, there are two. This actually does that question sort of delineates the use case of NFTs versus the use case of fungible tokens. Once you have a pool of NFTs or a pool of different assets, you can issue a token, and it makes total sense to do that. I mean, you can even, right now there's a war on tokens being securities versus commodities. You can even go register certain offerings of tokens compliantly and say, okay, this is going to represent this pool of properties like a REIT does, and allow investors to not only have access to that, but they can put it in a digital wallet, they can lend and borrow against it, they can do all the magic that you can do with DeFi, which is all revolutionary technology. But yeah, the underlying titles, the more we bring, basically the whole thesis, the more we bring real world assets, the titles for real world assets, or the ownership records of real world assets on chain, the more everything becomes composable, the more you can you overcome jurisdictional and governmental inefficiencies, and you can actually have everything in one place, which that's the innovation. So hopefully it happens, and we have to all drive that for the next cycle.
Thanks, Vivek. I really appreciate that overview of real estate and using NFTs for representation of assets. So tying this all back, Jason, you're an investment manager, and you've worked quite a bit with private equity funds. Can you talk about using NFTs and how you see that being added to the private equity landscape?
Yeah, I can chat generally. So I think Vivek touched on like a really important point where I think there's certain elements of crypto generally where it's very anti-establishment, and that's fine, but there's also a lot of room for collaboration and to eliminate a lot of the inefficiencies that, I saw like firsthand working in like the traditional finance space. I think when I was at the pension fund, we would invest heavily into like infrastructure, private markets, generally, so like private equity, etc. And when you're investing in these asset classes, which are completely illiquid, it's normally the biggest challenge you have is access. So in order to access some of the best assets out there, you're having to write $50 million, $100 million checks as a minimum just to get in there. As part of that, and through this whole process, and kind of Vivek talked about this with real estate, the same thing applies. You need a middleman, you need extensive legal contracts between these parties, and ultimately, like the ownership of these assets is very closed off, and that leads to essentially it's incredibly difficult to build a secondary market in traditional finance for these type of assets. What NFTs would allow is essentially that there's two things. Firstly is the ownership of the underlying asset, which can be then freely transferred and traded to essentially create a secondary market. And the second part is like you can even then have ownership of a fund level as an NFT and essentially own a percentage of the fund and create a secondary market that way. Now, why NFT is important for this? Well, we've already kind of seen tokenization of this happening. You know, we've seen some of the biggest funds in the world, like KKR, sort of already attempt this. The way I kind of view this generally is, when I was investing these assets, if I tried to recreate the return profile in my personal account, I couldn't do it. You can get ETFs which give you exposure to these asset classes, but because they're trading at a premium or a discount to the underlying value, the return profile actually looks very, very different to the underlying asset that you actually want. And so through the use of NFTs, you can essentially create an asset which represents the underlying return profile of these private markets in a way that can't be done through fungible tokens. And so by doing that, you're able to create access to these return profiles. You create the possibility of a secondary market which can be traded in a trustless manner without all the legalese in between. And it's a lot less friction on the system, and you eliminate a lot of the middlemen in the system, which is a huge cost on the entire process.
Thanks, Jason. I really appreciate that example. And the way I like to think about this is, do any of y'all stake ETH? Well, if you stake ETH, you probably, right now, we just got to this phase where we have withdrawals. But the example I like to think of is pre-withdrawal ETH. So I've seen protocols in the past, whenever you had an ETH position, they would issue you an NFT representing your staked position. And the idea is that before withdrawals are enabled, you get liquidity by selling your NFT. Someone then buys that NFT and then claims the staking rewards at a later period in time. Tying this to investments in traditional funds or like something like infrastructure, they may have a lockup period where I cannot take out my funds if they're doing some long duration infrastructure project. If I'm issued an NFT that represents my position and I need some liquidity, I would then sell my NFT and someone would then be purchasing my position with the metadata being terms such as the duration, the maturity, and those features. So tying this all together, how do we actually design this technology and what sort of tools exist to bring this stuff on chain? The one example I see is Chainlink. Chainlink has introduced this idea of dynamic NFTs. So what are dynamic NFTs and how do you use them for financial products? If you think about a traditional NFT, they are static NFTs. So an artist makes an artwork, it's issued on chain, and you cannot upgrade any of the metadata, it exists there. With a dynamic NFT, the metadata can then be upgraded as traits change. So the example I like to give is you use Chainlink to have dynamic metadata for these financial products that you're representing. For traditional bonds, you will have maturities or issuance dates that are represented. If you have bonds that have any sort of collateral, you could have collateral ratios as part of the metadata. I've even seen products change the art. So the idea is that you get this bond on chain, you have some artwork, you're now in the red on your collateral, the artwork changes and like has some sort of warning. Little fun idea, but you can definitely represent that via this dynamic NFT. And then tying this all back to Vivek's real estate example, if you have a home, you issue the NFT today, you'll have all the properties of that home, the square footage, the build, etc. Let's say time goes on, it's now 3 years later, you redo your roof. You can't update that because you've already issued a static NFT. The idea would be that if you represent your home via a dynamic NFT, as you upgrade your roof, as you have these buys and sells of this home, someone in the future can go back and see all this on a blockchain, and all the elements of your home have been updated on chain.
And I think one point which is we've kind of mentioned is when we think about this, there's a lot in theory that it makes so much sense. So like I think it will happen, and we're already kind of seeing projects build this out. I think a big drag on this at the moment is, in theory, you eliminate a lot of legal costs, you eliminate a lot of inefficiencies that currently exist in traditional markets. But how do we get to that stage where you have essentially a legal representation of ownership on chain, which can be freely tradable, and also the idea that people essentially can't get rugged. Like, your wallet gets hacked. How many times do we see that? We see it every day. Like, there's always a new high-profile NFT person. They have their wallet hacked. They lose their assets. Once you represent real-world assets on chain, how does that work? Like, these are kind of like the big questions, and there's several ways kind of about going around that. Whether it's like soul-bound tokens, which can't be freely transferred. There's also, I think, what's really important is the big legal push in the initial setup of these kind of infrastructure, and once that's in place, it allows for that. But it's just this kind of first mover requirement which we need for basically the protocols to like pioneer this. And once that legal precedent's in place, then we're going to be in a much greater spot. And I know that, Vivek, you've had like some experience of that in terms of like the real estate market. I'm just curious, like, what was your experience of that generally, and like how do you think that will evolve over time?
So we've been trying to bring real estate on chain I've had a real estate portfolio for 10 years. I've been trying to bring it on chain for years. The real problem is education, and that's the big barrier, is that the incumbency is so used to just having pieces of paper represent title, and they're so used to having bank lending take like 100-page documents, loan documents, and use the old way. It's just going to take time and education. I think we have to do that with open arms instead of trying to race around regulations. And we have to offer if we proactively offer regulatory solutions to the problems that people foresee, that's going to put us in a better spot. The one technology to talk about in more detail is soul-bound tokens. So soul-bound tokens are potentially an answer to the KYC question that the crypto always get, the identity question the crypto will always get, the sort of hacking and illicit money question will always get. Soul-bound tokens are basically, we all carry on identity. That's like probably one of the very few things that everyone right now in the room has on them, identity and their phone. And so if you can have an NFT that is attached to your wallet that has been cleared by XYZ player, governmental player, whatever, and that way your wallet is registered, suddenly that opens up the possibility that you can transact with all government approved wallets, all different real estate applications, banking applications. It's sort of, your wallet becomes your on-chain representation of like your bank vault at home or your personal possessions. And that's something, if we offer that and we show to regulators that you can actually have KYC'd identified wallets, and those can hold your real estate portfolio and your car title, as our friend's working on, or your digital JPEGs for your digital ownerships, as well as everything else that we bring on chain. I mean, that's how we get over the hurdle of sort of the stalemate we're at, where the incumbency doesn't want everything on chain, but we know the world's going digital, so it's inevitable. I'll end with, we think that our group's thesis is that the total market potential for the NFT space is magnitudes higher than the total market potential for the existing ERC20 space. So we really, like, the innovation, like with things like dynamic NFTs, is so much wider. There's so many more things we can create. And so and we're all at NFT.NYC, and this is a spot to focus on for the next bull market.
Yeah, and I think generally one thing that's an interesting point is, kind of like we said earlier, crypto ideologically is kind of being anti-establishment, anti kind of traditional finance, and I think there's a lot of disruption to be had there. That's like a huge market. But when we talk about these type of assets where you essentially have to have institutional buy-in and ownership of these assets, it can't, we're not just going to be able to create an anti-establishment marketplace for like these type of assets. It does require that kind of regulatory and institutional buy-in, or even like government buy-in to access this. And I think that's something that should be embraced to a certain extent. There's certain parts of crypto where, especially in DeFi, where it's amazing how far the technology has come and essentially removed the need for a lot of these institutions. But then on the other side, if we really want crypto to expand generally into what we all hope and believe it kind of can be, at some point we have to leave like our little insular crypto bubble where we trade crypto assets, and we have to really expand into the real world generally. And this is where NFTs come in, and this is where the institutional buy-in comes in, and we're already seeing it. Like KKR, T. Rowe Price, like these guys are all now investigating blockchain, and I think initially it'll be fungible tokens, and then eventually, as they get more comfortable with crypto generally, that's where I think a lot of the use cases we've talked about today will become more apparent, and we're going to see that adoption.
Yeah, you bring up a great point, Jason. And the way I like to think about this is there are three parties. There are the users or retail that are purchasing these products. There is the regulator, the government that is overseeing these products. And then there are the banks who actually have these assets. And what do the banks get from this? Why would they want to actually issue fungible or non-fungible tokens? The way I view it is it unlocks a lot of liquidity. So while traditional markets may be stale and it's really hard to get in and out of positions, by introducing these products, they can unlock liquidity. More people can get access to these asset classes. And the ethos of crypto is democratizing access. And so the idea would be traditional funds, large infrastructure funds that retail users can't afford or don't have access to, they unlock this liquidity. They can then have access to these funds, enter these positions, and enter this whole new asset class. Tying this to NFTs, the idea that if you have a position with smart contracts, you can actually embed features such as royalties that NFT collections use today. But the idea would be that if you enter a position, because you are getting access to this liquidity and you can exit out of your position, the bank will take some sort of spread for you selling your position. But for them, it's okay because more people are getting access. As it's changing hands, they're still earning some sort of revenue from these fees.
That's also another really important point to raise that Kunz brought up is we have to also package this to why, I mean, we all know why crypto would benefit us. And unfortunately for a lot of people, it's just number going up. And that's the wrong mentality. What we need to do is go to institutions like banks and say that NFTs, fungible tokens, et cetera, they will actually not only help banks make more money, but it'll also cut costs for banks. And that's the real use case that everyone can get behind. If we can get the crypto space to have lower transaction fees than the traditional system, which it definitely does. I think that part is unarguable, that now we can send money overseas instantaneously on a public blockchain. It's fully traceable. You don't need FedWire and like 80,000 different counterparties and delays. So it's already faster, it's already cheaper. But if it can also save the incumbencies money and help them, I mean, I worked at 4 banks in 10 years, and the amount of back office, the paperwork, the sort of technical overhead there, it's just not, it needs to modernize. And everyone knows it will modernize. We just have to show that crypto will help it modernize, and it'll actually help the financial system.
Yeah, and like just to add, like when I first started investing in the pension fund, transactions with like these large custodians that still do that, you know, were responsible for trillions of dollars. Those transactions were still occasionally being faxed over. So like you do $100 million transaction, you fax over like a signed copy of like the receipt. Like that's how, when we talk about the inefficiencies, you know, we're not talking about, oh, it's a bit quicker, it's a bit cheaper, like it is. And like there's a lot of savings there, but fundamentally, there's still a lot of systems which are incredibly broken in traditional finance, a lot of outdated systems which have been around since like the 80s, which have been built on top of so frequently that it's impossible for them to even like upgrade the system internally. Like they have to build essentially a new system, and this is where the likes of NFTs, blockchain generally comes in, where we offer a genuine solution to their problems. We offer a solution to the wider population's problems and democratize access to all these assets.
Thanks, Jason. And thank you, everyone, for attending this talk. We'll be outside, so if anyone wants to talk more about financial applications and NFTs, meet us outside. We're more than happy to answer questions. Thanks again.
Thank you.